This is the Progressive Dentist Podcast, where we help dentists like you improve your practice and teach you how to make more of what you make. Here's your host, Craig Cody.
Hello, Craig Cody here with the Progressive Dentist Podcast. Today we're going to be talking about tax planning and the 12 biggest mistakes that cost dentists thousands. We'll cover probably 3 or 4 of them today, and we'll leave the rest for another day. Is everybody out there satisfied with the amount of taxes you pay? Are you confident that you're taking advantage of every available break? Is your tax advisor giving you proactive advice to save on taxes? If you're like most dental practice owners, your answers are no, and If that's the case, I've got some bad news and I've got some good news. The bad news is you're right. You do pay too much tax, maybe thousands more per year than the law requires. You're most certainly not taking advantage of every tax break out there. Our tax code is thousands of pages long with thousands of pages more in regulations and guidance. The sad reality is there's probably no one alive taking advantage of every break they're entitled to simply because there are so many of them out there. And most tax advisors aren't very proactive when it comes to saving their clients' money. Sure, they get the right numbers in the right boxes, but it ends there. Nobody is being proactive. What we want you to do is we want you to take some time, communicate with your CPA, and ask them, what can I do a little bit differently that can save some more money? So first, we're going to talk about failing to plan, which is one of the biggest mistakes I see people making out there. Justice William Rehnquist said, there's nothing wrong with the strategy to avoid the payment of taxes. The Internal Revenue Code does not prevent that. Once again, the biggest mistake is failing to plan. I don't care how good you and your tax preparer are with a stack of receipts on April 15th. If you didn't know you could do something and it's after December 31st, it's too late to do that. Do you remember the last time you drove a car? You pull out of the driveway. Every once in a while, you're looking in the rearview mirror. Well, when you don't do tax planning, it's like always looking in the rearview mirror. It's too late to do anything. You need to be proactive, take the time, communicate with your CPA, and look for ways you can do certain things, maybe a little bit differently to save some money. Tax planning gives dental practice owners like yourself 2 powerful benefits that you can't get anywhere. First, it's the key to your financial defense. As a dental practice owner, you have 2 ways to put cash in your pocket. Financial offense, which is making more money, working harder, hiring an associate, dealing with more headaches. Or this financial defense, which means spending less money. For most people, spending less is easier than making more. Second, tax planning guarantees results. You can spend all sorts of time, effort, and money promoting your business, and that still won't guarantee results. Or you can set up a medical expense reimbursement plan, deduct the cost of your teenage daughter's braces, and guarantee savings. But those guaranteed results start with planning. You can't ever deduct money you spend on a medical expense reimbursement plan if you don't set it up in the first place. The second biggest mistake that I see dental owners make is audit paranoia. Now, nobody wants to get a letter from the IRS. I don't think there's anyone that's heart doesn't skip a beat when they get that letter from the IRS. But, let's be frank here. If you're doing things properly and you document what you're doing, you shouldn't really be worried about an IRS audit. What you need to do is you need to make sure you cross your T's, you dot your I's, and document everything you're doing. If the code says you can do it, but document it. Don't think you're going to wait till you get a letter from the IRS till you're going to document something, all right? Because, we're busy. We have, over time we'll forget things. So take the time, work with your CPA, come up with some proactive steps to take to save you money, and document what you're doing. The third mistake that I see dental practice owners making is operating out of the wrong entity. So let's talk about entities. We have C corporations, which there's not a whole lot of them out there these days. We have S corporations, we have partnerships, and we have sole proprietorships. A single member LLC is typically taxed as a sole proprietor. So let's talk about each of those. C corporations under the new tax law have a flat rate of 21%. The problem is you take all your money out in the form of salary, and then anything in addition to that you have to take out in the form of a dividend. So it's typically not the most tax efficient entity to work out of because in order to get a dividend, the company has to have income and pay tax on that income first. So for that reason, you do not see a whole lot of C corporations out there. S corporations, a little bit different. Basically, S corporations, like partnerships and like sole proprietors, are what we call pass-through entities, meaning the company itself does not pay tax. It may pay a fee to the state, but there's no exact tax by the federal government on that S corporation. The way that works is the owner takes a salary. It has to be reasonable compensation. I suggest you look at doing a compensation study if you're not sure whether you're taking a reasonable compensation. And then everything else after that flows through to the owner as profits in the form of a K-1. The K-1 is not subject to self-employment tax. It's not subject to the net investment tax. It's just subject to your regular income tax. So you see a lot of S corporations out there. We'll talk about partnerships. Partnerships are prevalent when there's typically more than one owner. They are also pass-through entities. Typically, there is no salary paid. You're taking a draw every month. And at the end of the year, you split the profits. You get a K-1 for your share of the profits. It's all subject to self-employment tax at the end of the year. And then we have the sole proprietor or the Schedule C single member LLC, which is, it's like a pass-through entity. It all flows through to your personal tax return, and every dollar is subject to self-employment tax, which is 15.3%. So where do people go wrong? Well, typically people go wrong because they don't plan. They're opening up a practice, maybe they're buying a practice, they're working with an attorney, whatever state they're in, the attorney says, well, probably from a liability standpoint, you're better off having an S corporation. And every state is a little bit different. So you form an S corporation. At no time typically does the attorney, the dentist, and the CPA get together and say, okay, what type of an entity should we be? What's going to give us the best legal protection? And what's going to give us the best tax protection? Typically that doesn't happen. A lot of times you can make what we call a late election. So you may be taxed as a partnership, or you may be taxed as a single member LLC, and you may be able to make a late election to be taxed as an S corporation, if that makes sense. Now, just because your buddy told you he was an S corporation doesn't always mean the S corporation is the best way to go. Especially these days with something we'll talk about on another episode, Section 199, which is the qualified business income deduction. So sometimes you could be shooting yourself in the foot by forming an S corporation or converting your partnership or your single member LLC to be taxed as an S corporation. So the main point here is you should be having a conversation with your CPA and your attorney before you form your entity. And if you've already formed your entity, you want to have a conversation with your CPA to see, is this the best tax strategy for me to be using? Should I be this type of entity? If not, is there a way out of it? Can we fix it? Can we take advantage of the laws and make it a late election to change it? So those are the three biggest mistakes I see out there. So it's failing to plan. It's being paranoid that I'm not going to do something because somebody said if I do that, I'm going to get audited. And third, operating out of the wrong business entity. Believe it or not, I once had a client operating out of the wrong business entity, cost them over $400,000 in additional tax. So it's well worth looking at and having that conversation. So until next time, have a great day. And remember, keep more of what you make, be proactive, work with your CPA, and communicate. Have a great day.
Thank you for tuning into this episode of the Progressive Dentist Podcast. We would greatly appreciate it if you left us a rating and review of the podcast so we can continue to help you and other dentists. Be sure to go to theprogressivedentist.com to learn more and make sure that you keep more of what you make.